GLS welcomes back. Now this series we are going to cover bank and balance sheet. As a banker, we need to understand the balance sheet of a bank. And obviously in any balance sheet, there is asset side and there is a liability side. Let's look at the asset side first because that's where the capital comes from. So in a liability side, we have capital, reserves and surplus, deposits, other liabilities and provisions. And of course, the contingent liability which comes below the line as is called in the jargon. On the asset side, we have cash and balance with Reserve Bank of India, balance with bank and money at call and short time, investments, advances, fixed assets and other assets. Now what are the major components? Let's look at the major components of bank balance sheet. Deposits are classified under BR Act as under demand deposits, saving bank deposits and term deposits. Now transaction in bank will of two types, cash and non-cash, that is transfer. So in other liabilities and provisions covers bills payable, that is payslip and demand draft payable, inter-office adjustment, that is net, interest accrued expenses and the other provisions. Cash and balances with RBI includes cash in hand, includes foreign currency notes, B, balance with RBI, current account and other account. Now minimum CRR is included under this head. Balance with bank and money at call short notice. Money at call, money means to be returned on next working day. Money at short notice means money to be returned in 1 to 15 days. Other type of money which is kept by bank are called term money, that is funds given for more than 14 days and less than a year. Next slide. In major components of bank's balance sheet, we are looking at other assets. A, inter-office adjustments net. B, interest accrued, that is income, tax paid in advance and tax deducted at source, stationery and stamps and non-banking assets acquired in satisfaction of claims. So these are all the components what we looked for just now. Major components of bank balance sheet. Now we discuss contingent liability. It includes claims against the bank not acknowledged as debts, liability for partly paid investment, liability on account of outstanding forward exchange contract, then guarantees, LCs, DPGs, DPGs means deferred payment guarantee, and lastly acceptances, endorsements and other obligations. Advances, bills discounted and purchased, cash credits, overdrafts and loans payable on demand, term loan, secured by tangible assets, covered by bank and government guarantees and unsecured. Then now we look at advances. So cash credit, that is arrangements are usually made against the security of commodities hypothecated and pledged with the bank. Overdraft, a customer may be allowed to overdraw his current account with or without security if it is temporary accommodations. Term loan or a demand loan or term loan as you may call it. Term loan may be given in the form of demand loan. Demand loan is payable on demand. It is for a shorter period not exceeding 1 year. With term loan is given for fixed term usually exceeding 1 year. So understand the difference between the two. Term loan always exceeds 1 year. Next slide. Asset classification and income recognition. So when we classify asset, one is performing asset, other is non-performing asset. In performing assets, we have assets on which income is received regularly and income is recognized on accrual basis. In non-performing asset or NPAs, assets which have stopped generating income and income recognized on cash basis only. Investment now. Investment in bank's balance sheet. So investment classification, SLR securities and non-SLR securities. Under SLR securities, we have government securities and approved securities by RBI. In case of non-SLR securities, we have shares, debentures, bonds, subsidiary of JV and others. Commercial paper, unit of mutual fund. Now all these assets are held to maturity, available for sale or held for trading. Now wherever these are held for maturity should not exceed 25%. Bank's total investment, profit and loss taken to profit and loss account, that transferred to general reserve and not marked to market. Remember, as far as held to maturity is concerned. Now, available for sale, in this case, profit and loss taken to P&L account and is called as mark to market. And lastly, held for trading. With this, we conclude the balance sheet now, and we'll have MCQs on balance sheet.